back, international oil prices surged by over 5% due to market concerns over potential disruptions in global crude oil supply. This follows Israel's threat to target Iran's oil production facilities. The West Texas Intermediate for November delivery increased by 5.5%. And it settled at over $73 a barrel in New York's Mercantile Exchange. And at the same time, Brent crude for December delivery added 5% to settle at over $77 per barrel on the London ICE Futures Exchange. All right, let's welcome now Director and Chief Economist at Econometrix, Dr. Azar Jammine, who is going to speak on the impact that this conflict in the Middle East might possibly have on petrol prices as well as inflation. Doctor, thank you so much for your time this afternoon. Welcome. So the R1 million question at this stage, I suppose, as South Africans, in light of these developments in the Middle East, already the markets are reacting with a 5% surge in oil prices. So should we be worrying about what the long-term implications as well as impact of oil prices could be, especially here in the country, but globally as well?
Yes, of course, globally and in South Africa, the rebound in oil prices means that the steep decline in fuel prices that we've seen in the last 5 months is likely to start being reversed from next month onwards. It's not only oil prices that have risen, but the effect of this conflagration in the Middle East has been to send investors scurrying into safe havens such as the US dollar, and that has contributed towards the rand weakening sharply against the dollar, which will exacerbate the increase in the rand price of crude oil. So it's not just that oil prices are rising, but also that the rand has been depreciating anew. That situation has been worsened still further by the release an hour ago of US employment figures that were far stronger than had been expected. And this is dampening hopes of a steep cut in US interest rates. And as a result, those people who have been investing in dollars to receive a high interest return until recently and have been unwinding those positions are now returning to the attractions of the dollar. And that is also putting downward pressure on the rand against the dollar and increasing the likelihood that fuel prices will rise next month rather than fall.
Doctor, I mean, with the projected fuel decrease here in South Africa, of which we were all looking forward to, I mean, over 100 days of no load shedding, positive growth in GDP, as well as the slashing of interest rates, we were actually hoping we were on a home stretch to some sort of economic freedom in our pockets. So in terms of inflation, I know you touched on it briefly, but what does this look like then for us in the long term?
As things stand now, the potential increase in fuel prices will not be as so dramatic as to reverse the declining trend of inflation. But of course, if there's an escalation in the conflict and oil prices rise a lot further, then it will nullify many of the benefits of declining inflation. As things stand now, there is clearly virtually no chance that the Reserve Bank will contemplate cutting interest rates by 0.5% before the end of the year. The most that we can look forward to is another 0.25% rate cut, which is not a disaster, but it's not quite as good as could have been the case.
And Doctor, what other economic effects then or implications could be as a direct result of this unrest? I mean, shipping has become a nightmare, leading, of course, to, expensive food prices. And then the cycle is just ongoing.
I think it's quite difficult to be dogmatic about the long-term impact of what is going on right now. Part of the reason why the US economy may be still creating so many jobs is that the massive armament supplies to Ukraine and Israel by the US are keeping that economy and the armaments industry very strong. It's also compelling the government, the US government, to borrow more money than it's ever done before. And that in turn is feeding more cash into the system and keeping the machine going. And as a result, interest rates may not come down as much as anticipated.
So what should we do? I mean, as normal citizens, should we be bracing ourselves to further tighten our belts pertaining to the usage of fuel, or we could possibly run into a situation where we do not have fuel in the country, Doctor?
No, I don't think it's, it's quite as dramatic as that. But certainly it's just, one needs to warn people not to overextend themselves financially on expectations of steep further declines in interest rates. Yes, there may well be further declines, but I don't think they're going to be particularly steep, and I don't think they are going to last beyond the next 6-9 months or so. So, don't hang your hat on the belief that you will be faced with a much lower interest bill if you've got debt, and therefore that you can afford to go and borrow a huge amount to sustain your living standards.
So basically, in turn, Doctor, this means South Africa has great interest in ensuring that there is peace in the Middle East.
Without a doubt, South Africa has interest in peace remaining in the Middle East. But as I say, there are some indirect potential benefits in that the arms supply carries on and picks up momentum, and that creates a demand for all sorts of commodities and for the production of all sorts of military equipment. And that can lead indirectly to sustaining commodity prices at higher levels than might otherwise have been the case. So it's not all a one-way street effect, one-way street negative effect. There can be some positive ones. If you recall, in 2003, the world was experiencing a sharp downturn in equity prices. And the day that the United States invaded Iraq with shock and awe was the bottom of that cycle. And from then on, you saw share prices rising, and rising quite strongly initially because of the military machine.
Thank you so much for instilling that hope and non-panic, Doctor. Thank you so much for that input. That is Dr. Azar Jammine, the Chief Economist at Econometrix.